Welcome to another episode of IBS, the Institute of Banking Studies. We have been discussing about the A module of the BFM paper for CAIIB Aspirants. We are discussing about the facilities to the exporters. Now, as a continuation, the next facility for an exporter, these are all the lot of facilities are there. Let us go it one by one. The first one is remittance of agency commission. As you know, the export business happens between two parties. One party will be in India and the other party will be in a foreign country. And in some time, the buyer and seller may not be knowing each other, or they may not be able to know who is need of the product which the person in India is exporting. So there comes the requirement or the need of a middleman. That means a broker or an agent. So then this forex brokers, they are acting as a middleman to connect the buyer and seller in a forex transaction. Because these two people are located at two different continents. That is the reason why in some time there is an involvement of a broker. And we have seen that all the people cannot act as a broker. They have to first get accreditation from FED for acting as a forex broker in India. So an accredited forex broker has canvassed, or he has connected the buyer and seller, and one particular transaction has been concluded. So this broker is eligible for agency commission. Therefore, the exporter can request the bank to pay the commission to the agent. The agent can be an Indian agent or it can be a foreign agent also. So therefore, if the payment of commission is declared in the declaration form. In the previous session, I have seen about the mandatory requirement for an exporter. And then when a person is making an export, he has to declare it in a specific format. And that is, there are two forms, EDF and Softex. And we have discussed all those things. So in the declaration form, the exporter has to mention this particular business has been solicited with the help of a broker and he is eligible for a payment of a commission. So if that is mentioned, you can allow. As a banker, you can allow what is the percentage mentioned, commission rate is mentioned in the declaration form, you can allow. But sometimes this may not be written or declared in the declaration form. Payment of this commission. In that case, the bank can allow the commission on merits. So look, the bank can allow the commission on merits. That is, with respect to payment of agency commission in respect of an export business. Number two, reduction in invoice value. Sometimes a shipment has taken place and the goods have gone, left Indian soil, and the document has given to the bank. That time, the exporter may request you reduce the value. The bill may be drawn for $1 lakh, and the exporter come to you. You make it $95,000. Make a concession, a reduction in the value. Whether as a banker you can allow that. Yes, it is permitted. And here the condition is, there are two situations. Number one, in the case of usance bill. What is in the usance bill? In the usance bill, there are two different types of transaction. One is demand bill, export bill, demand bill. Another is usance bill. In the case of demand bill, the payment has to be made immediately on demand. Or when the document is presented, the buyer has to make the payment. That is a demand bill. Second one is a usance bill. In usance bill, after accepting the document by the buyer, the documents will be delivered. They can take the goods from the shipping company or airline company, and the payment will be made on a later date. That is the benefit of a usance bill. Therefore, now the goods will be supplied now, payment on a later date. That is a usance bill. Let us assume a transaction has taken place with the usance period 3 months. That means the document will be handed over to the buyer and the goods might have reached the port. Then the buyer will come to the bank and they will accept. We have accepted the document. They will make an acceptance of the document and put their signature and seal, and they will make the payment on due date. So let us assume this happened on, say, 1/5. So 1/5/2020, May 1st, this acceptance has been given by the buyer. So the document have been given, bill of lading, other things, and they have taken the goods. Now the buyer need to pay after 3 months. The tenor is 3 months. So let us assume they have to make the payment on 1/8. Let us assume after 3 months. So on 1st of August, they have to make the payment. Now, after some time, say somewhere in June or in July, say 10th of July, let us assume this buyer has got some money. So then what he will do? He will contact the seller, the exporter in India. See, I need to pay only on 10th of August, but I have some money with, we have the surplus money with us. So we will make you the payment today, means 10th of August. And what you have to do? Give me a cash discount. So instead of making the payment on 1st of August, the buyer is making the payment on 10th July. So that unexpired period, from 10th July to 1st August, the 20 days or 21 days, you have to give a cash discount that you can allow. So if the payment is made in ahead of the scheduled date, due date, a cash discount can be allowed by the bank. And another rule is, AP, the authorized person or the bank can allow maximum of 25% reduction value. That means if 1 lakh is the value of the export bill, maximum reduction they can give is 25,000. That means $25,000. That means for 1 lakh, you can give a discount or you can reduce the value up to 75,000. So 25,000 reduction can be, that is called 25% can be allowed. But this will not be allowed to any person, subject to some conditions. And what are the conditions? Minimum price or restriction should not be there, and the exporter should not be in the caution list, exporter's caution list. If these two conditions are there, you can allow this 25%, maximum 25% reduction in the value. And there is another situation. This percentage reduction you need not take into account. For certain borrowers, who are they are, if they are in the business for a minimum period of 3 years with good track record, and export bill outstanding is not more than 5% of the average turnover, annual turnover for the preceding 3 years, then this 25% need not be looked into. Even you can allow more than that. Now, next is claim against export. This is another facility to the exporter. See, the exporter has to compete in the international market. That means international market, so many players are there. The suppliers are from China, from Japan, from Germany, from European countries. All other countries, they are all taking their product to the international market. Let us assume the market is New York. So from China, the product will come, the same product. From India also, it will be available there. So the people will be buying the quantity, the particular product which is of good quality at lesser rate. That means the Indian exporters has to compete in the international market. So therefore, what the price quality is one concern, price is also another major concern. Therefore, to compete in the market, the government of India gives some promotional, that means some incentive or some concession to the exporters. And one such facility is the claim against export. That means when an exporter is shipping his goods, the goods has to go to the customs authority, and there he has to pay the customs duty, excise duty. So let us assume the customs duty is 10%. So if a shipment is made for 1 lakh, 10% of 1 lakh, 10,000 they have to pay as duty. So that has to be remitted to the government. Then only they will approve the shipment. And then this 10,000 naturally the exporter has to load in the price. Therefore, the price will go up. The product may not be, there may not be much demand in the international market. Therefore, what the government says, first you make the payment of the duty, and once the bill is realized, you have done the export and the goods have reached there and the buyer had made the payment and we received the foreign exchange. After that, after realization of the export bill, this customs duty which they have paid at the time of shipment will be refunded. And that is called a claim against export. So the government will refund the duty which they have paid. And this for getting an amount from the government, it's very time consuming and lot of procedure and formalities they have to complete. So it may take 3 months, 4 months, 5 months time. And sometimes the exporter may not be able to wait. They may be in need of money. So what the exporter can do? Exporter can approach his bank. We have made an export. This much duty we have paid. This much amount we are eligible to get a refund. Can you give a finance against this refund? So bank will finance. And when the government pay the refund amount to the party, it will be directly adjusted with that credit facility. That is called a claim against export. And next facility is refund of export proceeds. Sometimes an export has taken place, the goods have reached, suppose the goods are exporting to New York, say ready-made garments. The goods have reached there, document has presented to the bank, the buyer had made the payment. So the buyer in New York made the payment. Then they collected the goods and they, on inspection, on opening the packet, the carton, they found that this is of inferior quality. This is not the one which they have asked for. Therefore, what they will do? They will contact the seller, the exporter. This is of not good quality. We don't want it. We are returning it. You pay back the money. It can happen. So what they will do? They will re-import it. They will send it back to India. And it will reach India. And it will pass through the customs authority. And the customs authority will issue a certificate, evidence of import. What is that? The bill of entry. So once the bill of entry is received by the exporter, and he takes this bill of entry to the bank and saying that the goods have been rejected, it has come to India, this is the proof, please allow refund. So you can allow refund. So the customer's account, you debit, you pay the money back to the buyer in the foreign country in US. That is refund of export proceeds. Then next is extension of time limit. We have seen the time limit is for normal export, it is 9 months. And for warehouse export, the time for realization is 15 months. And sometimes the exporter may not be getting the money within the prescribed time limit. Or the buyer in the foreign country, sometimes they did not make the payment in time. So what the exporter will do? They will contact the buyer. Buyer will say, I need some more time. So they just dilly-dally, or they will say, give me some extension time. So then the exporter will come to the bank and request for extension. Now the time is expiring now, 9 months is over or 15 months is over. Please give an extension. Please give me another 2 months, another 3 months, another 6 months. And there is a format, the format is ETX. So in the ETX format, extension of time limit, in form ETX, the exporter has to give a request to the authorized person, means to the bank which had negotiated that export bill, seeking extension of time. And the bank can look into it. And if they feel it is convinced, the banker is convinced about the reason for non-payment, you can allow an extension of time. And at a time, maximum, bank can allow 6 months. Bank can allow maximum 6 months, subject to certain conditions. Next slide will give you what are the conditions. Next is the effective date of realization. So a bill has been, goods have been exported, the bill has been given to the bank had negotiated it, they have sent to the correspondent. Let us assume the export is to US. The correspondent, say in New York, the bank had sent it to New York. And they requested the buyer to make the payment, and buyer made the payment. And the amount will be credited to the nostro account if the bill is done in foreign currency. So which is the effective date of realization? The date of credit of the foreign currency fund to the nostro account. That's what I mentioned. Effective date of realization, date of credit to the nostro account in the case of foreign currency bill, or it is date of debit to the ostro account if the bill is drawn in Indian rupee. The bill can be drawn in, export bill can be drawn in Indian rupee also. If the bill is drawn in Indian rupee, the correspondent will be maintaining, the foreign correspondent will be maintaining an account here. That is the ostro account. So the foreign correspondent will say, you debit our account. So either it is credit to the nostro account or it is the date of debit to the ostro account. Next is a write-off. An exporter had shipped the goods He had given the documents to the bank. Bank had negotiated or purchased and given the money to the exporter. Now the buyer in the foreign country, they are not making the payment. It can happen. Very rarely it may happen. The buyer in the foreign country, they are not making they have taken possession of the goods, but they're not making the payment. And so many correspondence and legal litigation, everything has been done, but it's of no use. It may happen. Just like you grant a loan and the borrower may not pay, and you try to recover, you take all measures. Sometimes it may be in vain. The bank may not be able to get back the money. At that situation, what the bank will do? Just write off. Isn't it? If there is no security and the borrower is absconding or the borrower is a very poor person, bank have no recourse to recover the money, we have to, no other way, write off. Similarly, the exporter has to write off. So what are the situations and what are the rules for writing off the export amount, export bill amount? And here the guideline is up to 5% of the export bill, the exporter can self-write off. And up to 10%, the write-off can be done by the bank. And in the case of units in SEZ unit or status holders, so a unit located in the special economic zone or status holders, they can write off maximum 10% of the bill amount, 10% of the total amount which they have realized during the calendar year. For example, in a calendar year, a particular firm had exported worth 100 crore. So 10% of 100 crore is 10%. 5% of 100 crore is 5 crore. Therefore, the exporter himself can write maximum of 5% of the total export realized during the calendar year. And the bank can realize 10% of the turnover. And if the unit is located in the special economic zone or it is classified as a status holder, they can self-write off 10%. And here the percentage restriction for writing off is not applicable in the following situations where suppose the buyer had declared insolvent. There is no other way, you have to write the entire amount. Or sometimes there was a settlement with the embassy. They have negotiated this much amount, just like we have the OTS. Then the balance amount you have to write off. Or sometimes the foreign chamber of commerce or embassy, the settlement comes, or the goods might have been auctioned or destroyed by the government. Sometimes the goods may not be usable or it's of inferior quality. The particular government may just destroy it. So in that case also, you have to write off the entire amount. The next is regarding extension of time limit. For extension of time limit, these are the guidelines. The following are the guidelines which the bank has to look into. Therefore, the exporter could not get back the money from the buyer in the foreign country. So then the exporter will come to the bank seeking extension. And when the exporter is seeking extension for realization of the proceeds, he has to apply in a format. That format is ETX. And the bank has to comply with these guidelines. Number one, this exporter, the goods are not covered under the investigation by ED or CBI. Sometimes that is possible. The enforcement directorate or CBI will be under investigation of this particular goods. In that case, you cannot grant the goods covered under exporter, not under investigation. Next, the exporter should give convincing reason why they need an extension. And the bank should get convinced. Then only bank can give. And maximum, bank can give 6 months. And within the permitted time, the bill has to be realized. And if the extension of request of time is beyond 1 year, so at a time 6 months, so from the date of shipment, if it is beyond 1 year, and the total outstanding in the export does not exceed 1 million or 10% of the average export during the preceding 3 financial years, whichever is higher. So remember, the request of extension for a period exceeding 1 year from the date of shipment can be allowed or permitted by the bank if this condition is satisfied. Total outstanding does not exceed $1 million or 10% of the average export realized, whichever is higher. And suppose the exporter had filed a suit, and then you can wait for the final decree of the court. You can allow time up to that period. This extension should be reported in EDPMS. Next is the foreign currency accounts maintained by the exporters. There are 3 different accounts denominated in foreign currency can be maintained by an exporter. One is OFC, second is DDA, and third is EEFC. Let us discuss one by one. OFC stands for Overseas Foreign Currency Account. There are situations where a manufacturer in India, they may be marketing their products in a foreign center by participating in a trade fair or in an exhibition. You are familiar with the Dubai trade fair in UAE. So every year they conduct a Dubai trade fair. A lot of companies from India, they are participating in the trade fair, and through the trade fair, they are selling their products. So let us assume a company is participating in the Dubai trade fair. So he will be, on consignment, he will be exporting to that place, and they will find out the buyers through the trade fair or exhibition, and they will sell it. So every day they will be selling some product. They will be getting the money. And this money daily they need not brought to India. They can open an account at that center. If it is they are participating in Dubai trade fair, they can open a bank account in Dubai. And all the sale proceeds can be put in that account, deposited in that account. And once the trade fair is closed, within 1 month from the date of closure of the trade fair or exhibition, the entire balance has to be brought back to India. That is the condition of OFC account. Next is DDA, that is Diamond Dollar Account. Diamond Dollar Account, there was a question carrying 3-4 marks previous year. Diamond Dollar Account, very simple concept. Look at a diamond merchant. What a diamond merchant does? A diamond merchant, first they will buy the raw diamond, or they import the raw diamond from US or from African countries, because there this is available in plenty. The diamond mines are there. So from the diamond mine located in African countries or in US, these diamond merchants, they import the raw diamond. And this raw diamond is imported, and they have to process it in their factory. And then they make the polished, the fine diamond, and that they will be exporting. Not only they are selling, doing domestic trade, but mostly they are making export. So as far as a diamond merchant is concerned, he has to do both export and import. In export, he will receive forex, and in import, he has to make payment in foreign currency. Therefore, this diamond merchants have been permitted to maintain maximum 5 diamond dollar account. So that's one question. Maximum number of accounts which a diamond merchant can maintain in India, diamond dollar account, it is 5. And any diamond merchant cannot open this account. There are another 2 conditions. The one condition is they should be in the line of business, having good track record for a period of 2 years. One more thing, and the average turnover for the preceding 3 financial years, 3 licensing years should be 3 crore. Therefore, average turnover should be rupees 3 crore or above, and they should be in the line of business, in diamond business, having good track record for a minimum period of 2 years. They are eligible for opening 5 diamond dollar account in India. So in the diamond dollar account, it will be the amount which they are getting. It will be placed in that dollar account. In USD, it will be maintained. And there is one more condition. It's a current account. And whatever amount is accumulated during a month has to be utilized for import before the last day of the succeeding month. I give an example. So let us assume in the month of June, there was total 100 crore USD. On various dates, this diamond merchant had exported diamond and they received the proceeds, the export bill proceeds amounting to USD 100 crore. Various date in the month of June. So that is lying there. And this amount, what's the purpose of parking the amount in dollar? Why don't they convert to Indian rupee? They get two benefits. One benefit is, if they convert to Indian rupee, we apply the buying rate, bank will take an exchange margin. A profit bank will take. So that they are losing that money. Again, when they go for making payment, you will apply the selling rate. Again, you take a charge, exchange. So both time, bank is levying exchange margin. So that the customer is losing. Not only that, when the customer give you, you are giving the buying rate. Let us say it is 85 rupees. When the customer comes for demanding dollar, you are applying the selling rate. It will be again more than the buying rate. So this is one benefit. The exchange loss will not be there. The exchange rate will not be charged if the amount is maintained in foreign currency. Second benefit the merchant is getting is, let us assume there is an appreciation in the value. When in the month of June, 1st of June or 5th of June, suppose a credit has come. That time the value of dollar may be 85. And by July, maybe 85, 50 or 86. So they will get that benefit if there is an appreciation, escalation in the value of dollar during the next month. So these two benefits, because of these two benefits, most of the diamond merchants, they hold some portion of the amount which they have received in foreign currency in the diamond dollar account. But the condition, this is the condition, there is no interest, this is placed in the current account. And suppose 100 crore is received in the month of June. This they have to use before 31/7. Suppose in the month of July, they have used 80 crore. So there is a balance outstanding 20 crore USD in the account. So what the bank has to do? On the last day, 31st July, after making the payment for all the import, if there is a balance, unutilized portion, say 20 crore, this you have to convert to Indian rupee and credit to the current account of this diamond merchant. So that's a condition. Now coming to the third one, EEFC, Exchange Earners Foreign Currency Account. Here any resident person who is earning foreign exchange, he is permitted to maintain this EEFC account in foreign currency, any foreign currency. Permitted foreign currency, they can maintain this account. And this is also current account, no interest is payable. Exporter can do it, or any resident individual can have this account. But here, this account also the same condition. Whatever forex is accumulated and credited to the EEFC account during a month has to be utilized for making payment of import or some other purpose before the last day of the succeeding month. That means if they have, in the July they have got $1 lakh that is credited in the account, they should use it before 31st of August. And if there is any leftover portion, unutilized portion as of 31st August, that amount has to be converted to Indian rupee. So this is the same condition for EEFC and DDA.